studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In this example, we are looking at a corporation that earns only passive investment income and has no active business operations. This is one of the simplest situations a tax preparer can encounter because all of the corporation's activities relate to investments. There is no need to decide whether expenses belong to active business income or investment income. Everything is investment related. Let's start on the left side of the slide. During the year, the corporation earns $15,800 of interest income and realizes $27,800 of capital gains. Together, these amounts create total investment revenue of $43,600. However, earning investment income often requires professional assistance. On the right side of the slide, we see that the corporation paid investment advisory fees of $4,780. These fees may include services such as portfolio management, wealth management, investment consulting, or advice from a financial advisor. Because these expenses were incurred to help generate investment income, they are generally deductible. Now look at the calculation in the center of the slide. We begin with total investment revenue of $43,600. From this amount, we subtract the investment advisory fees of $4,780. The result is accounting income of $38,820. This accounting income is what initially appears in the corporation's financial statements before any tax adjustments are made. The key concept highlighted at the bottom of the slide is extremely important. When a corporation earns only passive investment income, all related expenses normally belong to the investment activity. This makes the deduction process much more straightforward because there is no need to allocate expenses between different sources of income. As tax preparers, our first responsibility is to identify all investment income earned during the year. Our second responsibility is to identify all legitimate expenses incurred to earn that income. Once those expenses are deducted, we arrive at the corporation's accounting income, which becomes the starting point for the tax calculation process. In the next step, we'll see how accounting income is adjusted for tax purposes, particularly when capital gains are involved. In the previous slide, we calculated the corporation's accounting income after deducting investment advisory fees. Now we move to the next step, converting accounting income into taxable income. This is where many new tax preparers make a common mistake. They see a capital gain of $27,800 in the financial statements and assume that the entire amount is taxable. However, under Canadian tax rules, that is usually not the case. As shown in the center of the slide, the corporation earned a capital gain of $27,800, but only 50% of that gain is included in taxable income. So, we take the capital gain of $27,800, apply the 50% inclusion rate, and arrive at a taxable capital gain of $13,900. This distinction is extremely important because accounting records and tax calculations do not treat capital gains the same way. On the right side of the slide, notice the difference between the financial statements and the tax return. The accounting records report the full capital gain of $27,800 because accounting standards record the entire gain. However, the corporate tax return only includes the taxable capital gain, which in this example is $13,900. To make this transition, tax preparers use what is known as a Schedule 1 adjustment. The process is shown at the bottom of the slide. Step 1 is to deduct the full capital gain that was included in accounting income. In this example, we remove $27,800. Step 2 is to add back only the taxable portion of the gain. Here, that amount is $13,900. By making these two adjustments, we convert accounting income into the correct amount for tax purposes. The key concept to remember is simple. Accounting income includes the full capital gain, but taxable income includes only the taxable capital gain. Whenever you encounter capital gains in a corporation, always ask yourself whether the amount shown in the financial statements needs to be adjusted before it flows into the tax return. Understanding this adjustment is one of the most important skills in corporate tax preparation because it ensures that taxable income is calculated correctly and that the corporation does not overpay tax. This slide brings everything together and shows the complete journey from investment activity to taxable income. We are looking at a corporation that earns only passive investment income and incurs investment-related expenses during the year. Let's walk through the calculation step by step. The corporation first earns $15,800 of interest income and realizes a capital gain of $27,800. When we combine these two amounts, total investment revenue equals $43,600. Next, the corporation deducts investment advisory fees of $4,780. These fees were incurred to help manage and generate investment income and are generally deductible. After deducting those fees, the corporation arrives at accounting income of $38,820. At this point, many new tax preparers assume the work is complete. However, accounting income is not always the same as taxable income. This is where the Schedule 1 adjustment becomes important. Remember that accounting income includes the full capital gain of $27,800. For tax purposes, only the taxable portion of the capital gain is included. To make the adjustment, we first remove the full capital gain that is included in accounting income. Then we add back only the taxable capital gain of $13,900. These adjustments convert accounting income into the correct tax amount. After completing the Schedule 1 adjustment, the corporation arrives at taxable income of $24,920. Notice the comparison shown on the left side of the slide. If deductible investment expenses were ignored, taxable income would be higher and the corporation would pay more tax. By properly identifying and claiming legitimate investment expenses, taxable income is reduced, tax is reduced, and after-tax cash flow improves. On the right side of the slide, you'll see a practical checklist that every tax preparer should review. Confirm that the corporation earned investment income. Verify that the expense relates to earning that income. Ensure supporting documentation exists. Make sure the expense is properly recorded in the accounting records. Adjust capital gains correctly on Schedule 1. And confirm that only the taxable portion of the capital gain is included in taxable income. The key lesson from this example is that corporations with only passive investment income are often the easiest investment income files to prepare because all expenses relate to a single source of income. The process is straightforward. First, identify deductible investment expenses. Second, calculate taxable capital gains correctly. And third, convert accounting income into taxable income through the appropriate tax adjustments. Mastering this workflow provides a strong foundation for understanding more advanced corporate tax situations where active business income and investment income exist together.